Okay, so good morning class, let's start the class. Today, last week we were talking about purchasing function. So also last week I invited a guest speaker. I hope that you learned something. Last week also we talked about the purchasing function. Purchasing function is just like it's a one department. Usually it's one department that's responsible for buying stuff or selling a product, okay? Except for people or labor, okay? Which is handled by human resource or personal department, okay? Now this week we are continue to talk about the basic accounting or finance. Of course, that you will learn about the accounting class later on. It's a whole semester, but this is I only have a very basic introduction. It's very basic. Only one in this session. Okay. So accounting is also very important for every business because of course in every business we need to manage our financial condition or financial things. Accounting department or finance department basically is different things. But accounting it handles everything from small daily expenses to big financial decisions like mergers or closing a business. Okay, so basically for this accounting, uh, what they do, they are trying to manage the business daily expense and from the daily expense until big financial decision. Okay, business student, of course, you are more of SSM or IB student, especially for IB. But SSM also needs to know about this one because in the future you are prepared to handle your own business or become the manager. So business student or management department, management college of management should learn accounting unless they already know it well. So of course you don't really need to master because we have accounting manager or accounting officer, but at least you know the basic. So every accounting process starts with a document. So documentation is very important when we are talking about accounting. Okay. So this document triggers accounting action. In some advanced system, computers can handle data directly and print documents if needed. Because nowadays we will have like a software that handle or this activity, so you don't have to really manually. I think that before, like a couple years ago, 10, 20 years ago, you need to have like a manual record about your daily expense. But now we have a computer or software to handle this kind of things. So in the accounting, there are several important documents that you really need to pay attention. The first document is other people invoices or record of our purchases. For example, I think this is not only business. Me, as not a business, I'm just a human, a person, also needs to record my daily expense. Not really record, but like, oh, this month what kind of stuff that I bought, or what kind of money that I spent for. Number two is our invoices, record of our sales. So record of our purchases and record of your sales. Okay. And the third document is other people's credit notes or record of items we return to the suppliers. Okay. So basically, in accounting, you need to pay attention to these three types of documents. First, other people's invoices or record of our purchases. Number two, our own invoices, which is record of our sales. And the third one is other people credit notes or record of items we return to the supplier. Okay, so this is the three things usually you need to pay attention. Please digest first. Next document that we need to pay attention, number 4, is our credit notes, which is record of item customer return to us. Number 5, other formal documents such as legal deeds or bankruptcy notices, or definitely it's not really very common, but some important document that important for your business. Checks. Checks we send or receive usually after monthly statement. Okay. Check sometimes is very important if you have a very big business. If you're not your business not using that very so much cash, so check is very important. Number 7 is I think this is most important one is petty cash. So if you're the first time to hear about petty cash, so petty cash is like for small expenses. I think every office have this petty cash. Like I know that in our office, if I need like to the secretary and I say like I need to buy, for example, a paper for printing for my document, and then teacher you buy by yourself, and then they have like a wallet, and then they give me money. So petty cash usually for urgent small expense. Usually for every office have a petty cash. So this is for like for urgent needs. For example, urgent needs of course is for small things. For example, I need to go to the business trip, or I need to go to another school to give a speech, and then I need a taxi, money for taxi, and I go to my secretary and then I need money for my taxi, and then they open the wallet, office wallet, and then they give me. So petty cash is for a small expense and usually for urgent things, okay, or just small expense, usually cash, because it's petty cash is cash, so real money, okay. Make sure you understand the petty cash, okay? So a petty cash fund is a small amount of company cash. So if you would like to ask whether petty cash is cash or just like in the bank, so because it's petty cash, so it's cash, so it's real money. And often kept on hand, which is you put it in your own wallet or in the locked drawer, office box or the office wallet to pay for minor or incidental expenses. Like what I say, I really need to go to somewhere. I need a taxi. I need to go to the secretary. I need some, for example, 1,000 entity to go to Taoyuan, for example, to another city. Could you give me money? Okay, they give me petty cash. From petty cash. So petty cash fund is to pay for a minor or incidental expenses such as office supplies or employee reimbursement. Okay, so please digest first what is petty cash fund. So I have a video to overview about what is the accounting, the basic accounting. Let's check the video. Accounting is cool. It's really
Accounting is cooler than you think. It's way more important too. And here's why. Let's say you work for a company that makes ballpoint pens. You guys are good at making pens and you're turning a profit. Now, let's say you're in a meeting and someone asks, hey, shouldn't we make markers too? Well, your factory can produce them and your marketing team can sell them. But should you make them? Or should you just keep making pens? Everyone turns to the boss. And the boss, if he's smart, will turn to the accountant. Yep, the accountant. At this point, the accountant might just be the smartest person in the room, and certainly the most important. The accountant will talk with key partners, like the marketing, sales, manufacturing, and finance teams, to determine fixed and variable costs, market size, and potential revenue. She'll build a pro forma income statement to forecast profit profits and to determine how long it will take to recoup the initial investment. And she'll consider the impacts on the balance sheet that investors use to assess the financial health of your company.
什么叫我感觉就
Assuming it all
当
looks
感觉
good,
去
she'll
比较
determine
肯定
that making markers is a sound
带着你
decision,
去。
and then she will tell you
可是我又不可能那个，我不可能唱歌。
it's time to celebrate. You guys are making markers because making markers makes sense and dollars. Accountants are experts in analyzing complex financial data, picking heads and tails of it, and helping business leaders make smart investment decisions based on what the financial data says. It's why accounting is the language of business, and why knowing it can help you become a bigger asset for your company. Ready to add deep accounting knowledge to your bag of tricks?
So I'll stop here. So accounting mostly is very important because they will assess your financial condition, the financial condition of your business, whether your business is healthy or they going to bankruptcy. So this is the finance department or accounting department is very important. Okay. Okay. So in the accounting, what kind of entries do these documents create? So documents are entered in the books of original entry. So each document is recorded in the books of original entries, such as the purchases or sales day book. So they have like a daily book. So they will you need to record your expenses. And these books provide a dated record of every transaction. Don't forget to put a dated record of every transaction. However, like what I say, the modern system simplify this by using simultaneous entry method. For example, carbon paper. I did a couple of years ago using carbon paper. I don't think that you know about carbon paper. I think it's like a black paper, and then you need to put it behind the paper, and then when you write, and then you just like there is a double. Let me check it. I don't know if you have any idea of carbon paper. Nobody use this anymore. Carbon paper. This one is carbon paper. So this one is carbon paper. So you would like to put this like you write, and then like this one. So there is the yellow one. The yellow part is we call it carbon paper. So when you write in the white paper, they will have two duplicates in the yellow and also the pink paper. So we call it carbon paper. So your white is usually for your customer, I think, and then the yellow is for your own record, and then the pink also for your own record. So we call it carbon paper. So, but nowadays very seldom people using carbon paper. Yes, some of them still, but mostly we use software. We use like a scan and then like a barcode when you pay and you scan, and then they have like a record. But we used to use this one things like a carbon paper. Like carbon paper is like you put it behind the back in the white paper, and then when you write, you have a duplicate record behind it. So we call it carbon paper. I don't know. I think it's very few business use carbon paper because it's manual, right? Who would like to do the manual job right now? So like what I said, the modern system of using the software is simplified. We're not using carbon paper anymore because sometimes carbon paper, if you not really write with how do you say it? Is with you need to push. So in the carbon paper you can see clearly. If you don't push it very hard when you write, it's not clearly. The result is not good and clear. Okay. So we have a computer that can print out the book monthly, and alternatively, documents can be stored in loose leaf. You know loose leaf, right? Loose leaf binders. Anyone doesn't know loose leaf? Loose leaf binder. Copy. So this is carbon paper. So this is, if you ever notice, if you like a couple years ago we used this one. Loose leaf binders, just this one. Okay, loose leaf binder. So now we just use this one. If you print it out and then put it in this one, loose leaf binders. So you bind together. Okay. We call it loose leaf binder. Okay. Now, and usually accounting department, they have their own book. So not use like our general books like a book. No, they have a specific book. We call it ledger book. So usually you write some notes in this book. We call it ledger book. It's usually specifically used for accounting. Okay, to record the finance expense or the daily expense. So entries are posted to the ledger, and after being recorded in the books of original entry, every transaction is posted to the ledger. So every transaction you need to put. So this is kind of like a different kind of, because they have like a specific function. Okay. So what is ledger book? So a ledger is a book filled with individual pages called account, or a book collection of financial account. Okay, a ledger is a book filled with individual pages called accounts, or a book collection of financial account. Okay, so we call it ledger book. Okay, so what inside the ledger book? So in the ledger book, there are several things you need to pay attention. The first one is each account has a specific name and tracks something. For example, your personal account for individual or companies, and real account for physical things like furniture and fitting, and nominal account for intangible things, for example wages, which records into wage paid. So in the they have their own column, they have their own category. So you cannot put in the same page, no, because they have their own category. For example, for personal account, or real account, or nominal account. Okay. So before I start, let's check our attendance. Let's have the attendance check first. Now it's 9:30, 9:32. So for IB student, please prepare your phone. So this is for IB student. Please scan the QR code for the first hour attendance. Make sure that you scan successfully. Again, I remind you every single week that you need to check your attendance by yourself, both in the Tron class and also in the system. They should be the same. Okay, and then please make sure that you are below 17 hours. If you are 18 hours, you just need to say goodbye. So you don't have to come. You don't have to bother come. So you just continue, because it's gonna be failed. Not because of me, but because of the school. Okay? So if you are in the end of the semester, I will not receive any complaint about attendance. You are the one that's responsible about attendance. So please do not complain about me about your attendance in the end of the semester. Anyone from IP cannot scan the QR code, please raise your hand. IP student cannot scan the QR code, please raise your hand. Every student, all good? Every student that cannot scan the QR code, please raise your hand. Make sure that you scan successfully. Okay? This is for IB student. Okay? Good? Okay, so we move forward to SSM student. for SSM student, please scan the QR code for the SSM student. Same things for the SSM student, make sure that you check your attendance regularly, both in the Tron class and also the system. They should be the same, okay? So from the Tron class, they will retrieve the data into the system, okay? Make sure that you're below 17 hours. Again, I will not receive any complaint in the end of the semester because of the attendance. This is your responsibility. Okay, anyone cannot scan for SSM student? SSM student? Anyone cannot scan for SSM student? All good? All good? Okay, so I continue first. So what kind of entry would this document create? So this, in the ledger, there is a two kind of transaction, which is single entry and double entry. So what are they? What are the difference between single entry and double entry? So single entry bookkeeping is a cash system which simply record incoming and outgoing cash in a single ledger. Okay. And it's not used very often by professional accountant or bookkeepers. So single entry, there's two things you need to enter to this ledger book. There's two things is single entry and double entry. But usually single entry not used. It not used because it's kind of like a mess up and not really represent and accurately represent the financial condition. So usually business and professional, they use double entry. So most accountants, bookkeepers, and accounting software platforms, they use the double entry method for their accounting, okay? Under the system, your entire business is organized into individual accounts. So single entry bookkeeping is not, this is some of them used, but many of them not use single entry. They use double entry method. Okay, so I would like you need to watch this video, and we will discuss about this video, and I think it's easy to understand.
To better explain the concept of the double entry system, let us refer back to the accounting equation that we introduced in the third video of this series. Assets equals liabilities plus equity. And as we said before, the asset side shows what resources the business has, and the liability and equity side shows from where the business got these resources. There is a group of accounts under each one of these categories. If there is an increase in one of the asset accounts, then to maintain the balance of the equation, there should be a corresponding increase in one of the accounts on the other side of the equation, or an offsetting decrease in one of the accounts on the same side of the equation. In the previous video, Mr. Stick contributed cash of 100,000 to establish his business. The resource that the business got is the cash of 100,000, and that increase in cash is debited to the cash account, which is an asset account. That is the first part of the entry. The second part focuses on from where the business got that cash. It is the owner of the business who injected that cash to increase the capital of the business. So, there is an obligation to the owner of the business, and that obligation is recorded by increasing or crediting the capital account, which is an equity account, by 100,000. So the transaction was recorded in two accounts, and this is what we call the double entry bookkeeping. Assume that the business was granted a 50,000 loan from a bank. The resource that business got is the cash of 50,000, and that increase in cash is debited to the cash account, which is an asset account. The business got that cash from the bank as a loan, so there is an obligation to the bank for the amount of this loan, which should also be recorded, and therefore the loan account in the liability side is increased or credited by 50,000 to reflect that obligation. Also, this transaction was recorded in two accounts. Assume that the business bought a piece of land for 110,000 in cash. Here, the resource that the business got is the piece of land, and that is recorded by increasing or debiting the land account by 110,000. From where did the business get that piece of land? It is the business that paid for the land from its own cash. So, there is a decrease in cash, and that decrease is recorded by crediting the cash account by 110,000. So, any business transaction has a double effect, and therefore, recording any transaction involves at least two accounts. This is what we call a double entry bookkeeping.
Okay, so I will explain. I know that it's a little bit difficult, so let's see. So the first thing you need to know, there's an asset, liabilities, and equities. The asset is anything valuable that your company. Asset is something that you have. For example, equipment, land, building, vehicles, machines, any intellectual property, we call it asset. Okay, and liabilities is any debt of your company. You need to pay. Okay. Whether it's bank loans, you borrow money from bank, we call it liabilities. Okay, mortgages, unpaid bills, for any loan, it goes to the liabilities. And equity is the value left over for the owner after liabilities are settled. So, but asset and liabilities is very, very important. You need to understand what is asset, what is liabilities. Liabilities is your debt, your loan to the bank or to the any persons. And your asset is your property, what you have. For example, money, cash, car, building is we call it asset. Okay. So asset is something of value your company owns. Liability is any debt of your company owes, and equity is what left over. This one. I'm a little bit fast, so please, because in the second hour we will have another guest speaker. So I really okay. So, debit in the ledger book, there is two things. First one is debit and credit. Okay, so debit usually recorded on the left side of the account. So debit usually put in the left side, while credit on the right side. So debit is in the left side and the credit in the right side. Okay. Debit increases asset or expense and decrease liability. So debits increase asset. So everything that you become your property, become your things. For example, you have more money, you have more building, you have more cars. We put it in the debits. Okay. Well, a credit increase liabilities. For example, if business receive a loan, so credit is like where you get the money. Okay. Debit in the left, credit on the right. Okay. So, in double entry bookkeeping, every transaction affects two accounts. Like what I said, in the double entry bookkeeping, every transaction affects two accounts. One is debited, and the other is credited. Okay, debited and credit. Debit and credit. Debit is receiving goods, services, or money. So everything you receive going to debit. And everything, and the other is credit is giving or the things that you, how do you say, sell or you go out from your own, go out, we call it credit. So giving goods, service, or money. So everything that go out is we call it credit. Everything that comes in, we call it debit. Okay, we put it in the debit, not we call it debit. We put it as a debit. Okay. Okay. For example, from the video, let's say Mr. Stick got cash of $100,000 to establish his business. So Mr. Stick have money $100,000 to establish his business. So what we got? What Mr. Stick? What did he get? Mr. Stick got cash 100,000. So money comes in. Money comes in. So because the money comes in, we put it in the debit. Okay, put it in the debit. Okay. So what you receive, we put it in the debit. Okay. And then you need to ask the next question. From where Mr. Stick got the $100,000? Okay. So turn out that Mr. Stick, the owner of the business, injected the cash from his own pocket. So he has their own pocket. They have their own money to build a business. So 100,000 from their own pocket money, because 100,000 is the one that Mr. Stick need to spend out. So $100,000 put in the credit. Okay. So everything that's come in, put in the debit. Everything that goes out, everything that go out, put it in the credit. Okay. Or you can ask, what he get? If you get something, put in the debit, and from where you get the money, put it in the credit. Okay. So please keep in mind. So the credit part. So transaction was recorded in two accounts, and this we call it double entry because we need to put in the asset and the capital or credit. They have a different thing, so we call it double entry. So you need to put what you get and what you send, even though it's from your own money, you put it in the different columns. Okay, so you see this is equal. Okay, next. So and then next, Mr. Stick, the owner, they got another $50,000. So what did he get? Mr. Stick got loan $50,000 from bank. So there's another money comes in $50,000. So because this is money comes in, we put it into debit. Okay? Because you think that you have something, you put it in the debit. Okay? What did he get? He get money. How much the money? $50,000. Put in the debit. Okay? From where did he get? From where Mr. Stick got the 50,000. So the business got the cash from bank as a loan. So there is an obligation to bank for the amount of this loan, which should be recorded in the liability side, which is credited by 50,000 as Mr. Stick obligation to pay. So you need to ask, from where Mr. Stick got another $50,000? Oh, this is from bank. So this is because we let a loan, we need to put in the credit part. This one, loan. Another one, loan. Credit part, 50,000. So make sure every transaction, what money comes in and another loans, you need to put it in the another column. So from where did he get? He get 50,000 from bank. So we put it as a loan. 50,000 in the credit, not debit. Debit for anything that you have, okay, comes in. So put it in the credit. Okay. So therefore, Mr. Stick needs to record those transactions into two accounts, cash and loans. In total, Mr. Stick has three accounts: cash, loan, and capital. So they have a three account. Cash, something that now they have. So now Mr. Stick business has 150,000. 150,000 from their own money, their own pocket, and 50,000 from the loan from the bank. Okay. Okay. Next step, and then the other day, Mr. Stick bought a piece of land. So he buy another land for 110,000 in cash. Okay, so another property, another things comes in. Okay, another things coming, which is his land. Even though it's land, but this is something that you have. Okay, because this land is not money, even though the land it have amount of money, but it's land. You cannot put it in the bank, right? So everything comes in, we need to put in the debit. Okay, but difference because this is cash, real money. Land is land, so you need to have another column, another table, which is debit for land, which is we accounted for $110,000. Okay. Okay, debit is everything that comes in. Next, from where Mr. Stick has money to buy land? Okay, you need to ask, from where Mr. Stick has money to buy land? So in fact, from his own money. So they buy the land because they have 150, and then they need to buy land. So from where Mr. Stick has money to buy land? In fact, from his own money or his own cash. Therefore, he needs to credit it, something that goes out. You need to put it in the credit. So his own money in the credit column. So you need to put in the 110 here in the cash. Okay. So from where he got the 110 from their own cash. So they need to put it here, credit in the column of credit cash. Okay. So any business transaction that Mr. Stick done having a double effect, and therefore recording any transaction involves at least two accounts, debit, credit. Okay. So you make sure that in accounting, when you buy and you expend something, you need to put in the debit and credit. Don't get it wrong. Okay. If you notice that usually the accounting debit is totally different with our daily transaction in the bank. So if you go to the supermarket, you would like to use a ATM to pay, right? Usually we call it debit. The concept is different, okay? For this one, debit is something that comes in as your property. But if our daily transaction, debit is something that we spend, okay? So debit in this accounting, everything that become your property, land, cash, vehicles, machine, put it in debit, and credit is from where you get the money. Okay? So there is another example. You need to take a look by yourself. I can have this one. I think it's very quick. So, for example, buying office supply with a cash. Your purchase office supplies for 100 and paid with a cash. Okay, you buy 100 for office supply. So, double entry bookkeeping requires recording this transaction into the account debit of what we got and from where we got a credit. So, for in this case, I would like to buy a pencil or pen. $100. Okay, so what I need to do is I need to debit my office because I now have my own pencil. Pencil $100, but I need to credit in my account, my cash account. Okay, because I need to spend money 100. Okay. Okay. And what I said today we will have a guest speaker. And the guest speaker is a little bit different. So, let me turn this one first. So today, our dean invited Professor Robert Gebner from Germany to be in our class. Okay. Okay. So he's a professor in the Technical University Applied Science in Germany, and he will come to our class. I know this is a little bit different with the last week. Last week is professional because he owned the business, and then maybe the way he talk is straightforward, and then you can more how do you say, more extrovert. But I think that we will listen from academia. It's a little bit different when they have a guest speaker. However, you need to respect, okay? And today, Professor Robert Kepner will talk about computer things. The thought of computer, real or unreal. Okay, so this is what so because Professor Robert Kepner is the research area, or their specialty is about the computer science and computer engineering. So he would like to share his own expertise, his own research about how computer can calculate, obviously much better than human being can. I think it's really related with our topic today. We're talking about accounting, right? Before we use manual to know the, how do you say, any transaction, but today Professor Robert Kepner would like to say that the computer also can help calculate, okay, to replace the human being, what human being can. So they said the lecture later on will explain about how computer already used in the same atomic element as our brain. So they were very, I think that's a chat. Sometimes every week I need to check your homework. I really cannot differentiate between the ChatGPT and your own answer. But you know that something too good to be true is not true. If your life is like a very, how do you say it, perfect, there's something wrong. Like your answer, sometimes every week, your answer is just very, it's not like the first year student can deliver opinion. It should be ChatGPT. It's very, frankly speaking, with something that too good to be true is not true. It's even not in the things, even in your life. If you're like you're handsome, read something that looks like very ideal, it's something there's always something wrong with it. So too good to be true is not true. So anyhow, so now we're Professor. I will not talk about this one, and we will waiting for the Professor Robert Kepner. Today, the Professor Steve, our Dean, really, Professor Steve, our Dean, this morning informed me that I need to take care of the students. So please, I know maybe the topic is not really interesting you or really math, or maybe it's too high for you because you are a first year student, but try to show respect. Like, for example, please do not sleep in the class, okay? Last week, I saw many students just sleep. Like there's two girls here, there's very last week, they just put a hoodie and a sleep. Okay, and then a lot of students that put the earphone. Please be respect for today because it's very important, and Dean will also come to our class. So with that said, I hope that the one that sit behind, please come forward to fill in the front row. Okay, you behind, or okay, good, 3 or 4 of you behind. Please come forward to the first row now, and then. And also, please, please also come forward so you can record clearly, okay? So, while we are waiting, if you would like to go to the restroom, you can go to the restroom, and I will check the attendance at 10:10, okay? For whom that you, please fill the first row, okay? Please fill the first row.